Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, May 8th, 2023. It's 11:45 a.m. Eastern Times. I'm starting the video, and what I'm going to do in this one is update, as I usually start with the equity markets, and then hit on some of the trade ideas I've thrown out in the last couple months. It will not be all inclusive. There's things thrown out here and there, but what I'll try to hit on are some of the individual stocks I've thrown out over the last couple months as trade ideas, and some of the commodities as well. And I'll get to one second, mention I'll be leaving for vacation this Friday. And if you followed right side of the chart for a while, you'll know there's it's starting to become an ongoing thing, the RP vacation indicator. Seems every time that I have a vacation planned, right about when I leave is when that next turn in the market that I've been looking for comes. So we'll look at that real quick, show you last few times I took vacation, what the markets did. Pretty interesting. Anywho, let's start out with the NASDAQ 100. If you are frustrated with this market, welcome to the game. This is what it does sometimes. It's gone completely sideways now for almost 6 weeks. This is we started back here in late March, and we're bouncing around top, bottom. You can see the range, one little whipsaw to the downside. NQ, again, you have a very well-defined top, and we've hit that top now 3 times, at least the way it's defined here. It's about 13,385, you can see right there. And this most recent top high right here was a divergent high. So if you look at it on the very top, you have this uptrend line right here, or divergence line, I should say. We had divergence there. We've really had divergence all along since this point. You have to zoom out in the longer term. It shows through better on the daily charts. When you see long divergences like this on the 60, again, that's where you want to take a look at it on the more significant daily chart. So really, these highs were a little bit higher than this one, and the indicators have been making equal, now lower highs. That is negative divergence. Doesn't guarantee anything. I will give this market full credit for how resilient it is. It's just been holding up, despite some pretty clear negative fundamental headwinds, both real and potential, such as we'll talk about the debt ceiling. That's going to be the next thing. So here's what I wanted to talk to you about. I'll share my thoughts. Number one is that, yeah, we've been in this range. If you're frustrated, welcome to the club. Bulls aren't making money. Bears aren't making money. And I'm talking, well, we can look at the S&P as well. I was talking about the NASDAQ here. And, sooner or later it's going to break one way or the other. But I think, unfortunately, a week ago I told you it's going to be a little while. You're going to have the Fed meeting, which we had last week. That's out of the way. Check mark. Apple, the last of the big tech stocks reporting, check mark. I figured the market would probably pick a direction this week. And it could. I'm not going to tell you that it could, but we're going to start to increasingly turn our focus to the debt ceiling. And as we know, the two teams up in D.C. don't play so well together nowadays. So we'll see. I don't expect any quick resolution. Probably going to go down to the wire. May even see. Who knows? We'll see what happens here. I just want to say that also is going to give increased odds that this thing could have another whipsaw. Remember, this was a whipsaw, downside break right there. That was a well-defined bottom of the range, and we could have another whipsaw up or down. I know you don't want to hear that, but that's, again, it increases the odds. Nothing has changed on my longer term outlook. I still favor whether we have a brief pop to the upside, and it would, potentially should bring in, clear a lot of stops from short sellers that have their stops placed above the top of the range. Likewise, long side traders will probably go long there. And this is how the stock market works. If there are, and it's really very simple if you can look at it this way, if there are more willing buyers on the sidelines right now, more people and institutions, even the bots will follow whatever. The bots, in computerized trading, they'll kind of jump on whichever way things go, at least the high frequency traders or programs. But if there's more buyers on the sidelines right now, then this breakout should stick, whether we backtest or not. If there are not, then what happens if you do get an upside breakout, it should get sold into and fail. If there's more willing sellers, people that want out of this market, institutions that want out, ultimately stocks go up and down from one simple force. It's supply and demand dynamics. more buyers on a stock or the market, or which is really culmination of all the stocks and the indexes, that goes up. And if there's more sellers, it goes down. So we'll see. And I know that's simple stuff, and I know you probably want to hear, but I'll tell you, my views haven't changed. Like I said, any breakout's probably going to fail. I put good odds on that. And look, we haven't even broken out. Like I like to say, resistance is resistance until and unless broken. And that resistance has not been broken. The bulls had the opportunity today. They were flagging the indexes here. Both I got that out to you this morning. You had nice little, pretty much textbook looking little bear flag patterns right there. You had a nice pulsar leg up, a flagpole, and that could have broke out, but it didn't. Now, it doesn't mean we can't go up anymore. It just says that flag really has been foiled both in symmetry and as far as the pattern goes, and it's a little long in the tooth, and it kind of came down there. So it's just sloppiness. This is what we're looking at here, guys. Sloppy trading. All right, let me get to a few other things. So there's the NASDAQ 100. Still has the divergences and everything else. S&P 500, let me give you that real quick update. Same one I got out to you this morning. It's also a 60-minute chart like we were just looking at on NQ. You had the potential bull flag pattern there with the impulsive leg up, but we've kind of just chopped around. And again, you can see the S&P 500 is still well below its recent high. Its trading range is not as well as defined as the NASDAQ 100, but you could also box it in like that and say you have the two distinct highs instead of three, a couple of distinct lows. There was kind of a sub-range there before that seemed to be the range. Here, let me show it to you this way. That's how I see it. We had a range right here, and these are levels that are still significant levels. So you had an upside break that failed, then a downside break, another upside break that failed, downside break. So that's why I expanded that to a little bit larger range, and that's what you need to see. So bulls need to and want to see the S&P 500 futures break up above that range. Bears want to see a downside break. Will that be a definitive resolution of the pattern? It may or it may not. Again, that's a big fundamental catalyst and psychological catalyst for the market. I'm talking about the debt ceiling and how that gets resolved. So let's talk about what the market may do and when it may do it. Let me go to the S&P 500 here. Let's go to SPY. Take a look at it real quickly. Let's go to we can leave that on a 60-minute chart. Okay, here's the SPY 60. I'm going to go through these charts real quick. I want to show you all the major indexes, both the regular and the equal weighted, and then I'm going to move on to some individual trade ideas. There's the previous reaction high. This one was a little lower so far. For all intents and purposes, almost an equal high there. And so that's a pretty big resistance level you need to take out, about 418 on SPY for the bulls. And then below, it's the same trading range. Remember, we had that smaller trading range I just showed you on ES, the S&P 500 futures. This is a 60-minute chart of SPY. Then you had those two whipsaws below. So now that's really the line right there that should be colored up. We'll just leave it there for now. About 404 right there on SPY, and then of course you have the recent high. And again, this trading range, the top of it's not as well defined, but that's some sloppy trading for you. Back, forth, back, forth, back, forth. All right, so that's that. And it's these negative divergences that tell me that most likely the ultimate resolution, at least as of now, as long as these divergences remain intact, will be to the downside. And so far, we had a divergent high and we're moving lower. We're stair-stepping lower. So let's just watch the SPY if you want to really, remember, take some things with a grain of salt and this kind of volatility in this trading range. Breakouts tend to fail. But you do have so far 3 lower highs and lower lows here. And so if SPY reverses here, goes down, takes out that low, you are going to have the early makings of a downtrend right there. And of course, that's a big level there. If it takes out that low, that 404, you've now popped the bottom of the trading range, and that has more significant bearish implications. And it's based on the posture of the charts and everything I'm seeing. That's still what I favor. Like I said, got to give this market points for holding up as long as it has, despite these divergences. When I jump out to the daily time frame, there it is, divergent high. We've been diverging since back here. Okay, and it's not as if the divergences didn't play out. You had well, correct me. I'm sorry, correction. Uh, the SPY had a divergent high only on the PPO, had a significant correction, and that was right at the top. This was my most likely bounce target zone from all the way back off the October lows, and then this was my maximum bounce target zone. So if you take that line across, we really have just been flirting with the top of my most likely bounce target zone, and that's where we remain. And I wanted to point out that so you started the divergence there, and then the RSI started to diverge as well, and it's made lower lows. Trying to get my line tool going there, so you can see big divergence on the S&P right there as we made that marginal new high right there, and there's your trading range. So that's it. I know I'm giving you the same thing over and over, and it's repetitive, and that's what happens when you're in a trading range. So watch and respect which way it breaks, and then this is where things start to change for me. If we take out these previous major reaction highs from back in August in both SPY and QQQ, this is what QQQ looks like on a daily chart. There's your previous reaction high from back in August as well. We're still below it. That aligns with the top of my max potential bounce target zone, which we're in the middle of right now. And that was my most likely bounce target zone where we got rejected off a couple times. And this is the recent trading range. These are the divergences that are still very much intact. And that still, in my opinion, gives us the best bearish setup that I've seen since the highs. Now let's talk about those highs. Let's talk about the RP vacation indicator. All right, so the last couple vacations I took were, here we go. I went to the Keys in August. Told you I'd be out for a little while there. Maui back in May, and I'm going to Kauai, leaving on flight leaves early Friday morning. So I will be MIA. It's 3 flights to get there. Fly Fort Myers, Atlanta. Where is it? Seattle, I think. So it's going to be a day and a half of travel, and so I'll be offline there. Maybe I'll, if there's anything big, I'll connect on Wi-Fi on the plane and get it out to you. But it seems, where I'm going with this, I'm not trying to ramble. It just seems that's, for whatever reason, every time there's a setup and it looks like we're going to get a turn, whether it's bullish or bearish, that usually comes right around vacation. So let's start out with this one here. St. Lucia back in November 21st to 26th, and that was right here. The high, the all-time high of the NASDAQ 100, the end of one of the greatest bull markets in history, came on the 22nd, the day after that vacation started. And of course, analysis up to then, we had all kinds of sell signals, divergences. We were short. And I just want to say, of course, that was the inflection point. It came, there's a nice bearish engulfing candle and everything. So you can see again right there. Then the next one was Maui. Going into that, that was the 14th of May. Let me put my little candle crosshairs right on it, right actually there. So we had that. We were coming in short. Believe at that time, and you can go back and check, covering shorts, looking for a quick bounce on the short-term charts. Then we got that major bottom right there at the tail end of that vacation. Had a nice, and again, it was an inflection point. There was a rally here of about 11.5%, and I believe that was set up with it. We had 60-minute divergences, and it was a tradable bounce. Then we had finally after that, the last leg down up to that point. Keys trip right there. Look at that. These are major inflection points. So that I was gone from the 19th, which is right there, right on that red candle, and we'll short that point. We had milked that rally on the way up, and next leg down came. So here we go. So, anyways, I'll be out Thursday. Will be the last day this week, and therefore, if this continues. An inflection point means if you're going up, then you start going down. We'll see if that's the case. Now, we could also be, again, I have to acknowledge that if we get a solid breakout and it doesn't fail right away and they build on it, maybe the inflection point is just going to be a breakout of that trading range, that sideways range that we've been in lately, which again would be boxed in like that. if we look at it this way. So, but based on what the charts are indicating, like I said, upside break or not, I think the ultimate resolution will be to the downside. But let me say this, don't get married to that. I am certainly not leaving town for I think it's 7-8 days for without any stops in place on any swing short positions or really any positions at all, long or short. The takeaway is do not get married to it. The market doesn't have to do anything. Divergences don't have to play out. But this is what we're looking at here. Keep it simple. You've got this wedge forming in the NASDAQ 100 right there. There's your uptrend line. There's your divergence line. And a break of that uptrend line would be the first sell signal, and then much, much bigger and much more important, a break of that 312 level. Or as I said, last couple of weeks, that reaction low we had, remember we had that false breakdown. I think the break of 312 will do the trick. If we get back down there again and break it one more time, it'll probably do the trick. That would be kind of your all-in moment right there, a break of that low from April 25th. Okay, let's go through the other indexes real quick. There's QQQ, the NASDAQ 100. We all know, if you've been listening to my voice, really tuned into the markets at all, we know that it's been all about big tech. Big tech has nearly single-handedly lifted the markets since the beginning of the year. And I'm talking about Apple, Microsoft, Amazon, Alphabet, Meta, Tesla. They're all those earnings are out of the way now. You have QQQE is singing a different song. This is the equal weighted NASDAQ 100. That's the best downtrend line I can draw on it. And you can see that we don't have the same trading range, and we're not pushing the highs of the trading range. So we still continue to see poor breath in the stock market. And that is the majority of stocks aren't doing as well as the major indexes, especially the NASDAQ 100 would indicate. Because again, most of the returns have come from those big techs. And like I've said before, this is unique. I've seen, it seems that they've morphed into flight to safety instruments, which is, in my opinion, absolutely ludicrous. These are growth companies. They're economically sensitive. I don't care how big their stock buyback plans are. You can go back in time and look at previous bear markets and previous corrections. And, when the tide turns, if the market drops, they go down, and their companies will just be buying their shares back lower and lower prices, which is going to be offset with excessive selling. As much as Apple and Alphabet are buying their, have set aside the money to buy back their shares, the stock market is huge. They have a lot more market capitalization. There's a lot more money, a lot more shares of Apple stock in individuals' hands and pension funds and hedge funds. So, if they decide to sell, whether it's willing or unwilling, meaning forced selling from margin call selling, and that's what tends to happen. I think most people don't understand how the market can turn around and drop so fast. When you start going down, you go down, you break one support level after another, selling begins to accelerate. Consumers or investor sentiment shifts pretty quickly. You go from a bullish tape to a bearish tape in short order, and it's not so much measured in time; it's more measured in percentage drops. So you go down like this is going to be a slower roll from sentiment, and you go down sharply. There's nothing like a swift 10, 12, 15% drop to all of a sudden, getting everyone singing the bullish tune. All I'm hearing more and more is about new highs in the market lately, and we'll see. So anyway, I just wanted to point out that's lagging. And, if you are bullish, what you want to see is you want to start to see some participation in the other, 90-something stocks in the NASDAQ 100, not just those big ones. So there it is. And from a technical perspective, again, you can see this is pretty much triangle pattern right here. You have an uptrend line and a downtrend line. And you also have these two previous reaction highs. So bulls want to see that get taken out, those two, and then there's that one there. So you have a series of lower highs there. And it's really, again, it's anybody's game because you have higher lows, but you also have lower highs, 1, 2, 3. So this is, again, it's incremental, not all or none, but this is where you get a check mark for the bulls if they take out that high. then that high, then that high, and that's how it works. Likewise, on the downside, there's a reaction high, there's one, and you get anywhere near this one down here, then I think that's where you'll start to waterfall, and the selling will begin to accelerate. Upside potential, can it go the other way? Absolutely, it sure can. But I think there's still a lot of fundamental headwinds, and technically speaking, there's some long-term indicators still remain bearish. All right, let me go a little faster here. So SPY, I already gave that to you on the 60, as well as a daily. Remember, we have this divergence here, right there, and the bullish case, and I'll certainly recognize it. You had the primary bear market downtrend line, breakout, back test. We had a one-day failure and then got back above it, but you've had this divergence building. You still have the divergence and you're in that trading range. So that's the S&P 500, which is also a market cap weighted index, meaning the bigger the companies. I haven't updated this in a while. I've updated QQQ, but Apple, Micro, you can see they have an over weighting on those because their market cap is so large. But so you can type in RSP, that gives you the equal weighted S&P 500. So this kind of, you lift up the hood if you want to see how the entire index or the stock market's doing. This is a much better guide because it's going to average. It gives every stock in the S&P an equal weighting, of course. And you can see here, the best downtrend line I can fit is this one. You have plenty of reactions. And 1, 2, trying to grab that for you. 1, 2, 3, 4, 5. You have a breakout and a failure there. So that was a false breakout. You're back in the trend line, and it's continued to respect its sense. So you have that downtrend line and this uptrend line. So that is a big triangle pattern. So again, not to oversimplify it, but a solid upside break, bullish, as long as it holds, and a solid downside break, bearish. And just like the NASDAQ 100, watch these reaction lows. Traders will be. If and as each one is taken out, that's bearish. And likewise, watch these reaction highs. And ditto, bullish if and as each one's taken out. So that's that. You have the Wilshire 5000, which is probably the single best index because this is a total market cap. It's got all small, mid, large. So this is in my opinion, the best measure of the stock market. It's if you're going to use one index, and you can see you've got a couple trend lines. None that I'm crazy about, but that's our uppermost downtrend line. You can say what you want. Like I said, bulls can make a case that the bear market's over because they've been making higher highs, right, and higher lows. That's making of an uptrend. If they take out this high, they will have a higher high. And likewise, that's in the intermediate term. We know the market bottomed so far in October, and so it's in an intermediate term uptrend. The million-dollar question is the longer-term trend changed? There's no evidence to that yet, or very little, very scant evidence. Again, how you want to interpret it and read the tea leaves. But so far, you have a series of lower highs, very clear lower highs, and a series of lower lows, right? Okay, so this is it, guys. We're at I think this is the way the market's going to break, but you're going to need to see it take out these previous lows and not take out these previous highs. We've been cutting through the 200 days, up, above, below. We're in very close proximity, not far away on the upside enough to say that they've clearly been taken out. Okay, so I showed you the equal weighted. You can look at the small caps, IWM. Small caps are below their 200-day moving averages. There's bullish when you're above them. They drop below them here. Back tested, rejected, 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 rejected. Broke out but couldn't hold it, failed. That's bear market action, and you're below them now. But it's still anybody's game, and I'll turn on all the lines here. So lines that stand out to me, I know this is a busy board, a lot of lines, but right there is your uptrend line. You have 1, 2, 3 clean reaction lows and a nice, pretty steep downtrend line right there. Plenty of overhead resistance if the downtrend line gets popped, but if it does, it's probably going to take you up to about right here. You can see, and this one is very heavily weighted on the regional banks. So you'll notice that if you're trading KRE or any of the regionals, And IWM, there's pretty tight correlation because of the large amount of regional banks in that index there. And of course, you have in the middle of that, between the small and the large caps, is your mid caps, or are your mid caps, I'm sorry, MDY. And MDY, let's see if I have it marked up here. If not, I'll mark it up. There's your uptrend line, nice and clean, right? And the best I can do is this downtrend line. We have the downtrend line off the highs right here. If I draw this one at this point, I think that's the best fit. In the same thing, a little false breakout here because you have enough reactions. If not, this is the BOD. You could certainly, the mid caps could certainly rally up to there, bigger picture stuff, and keep the bear market intact as long as they reverse off that trend line, which will come in because trend lines are dynamic. It's always coming in at lower levels every day, so it's going to be below that low. So that would still, if it turned and we took out the previous lows, keep the bear market intact. Or we get rejected here. Bottom line is, let's watch this trend line right there on all these indexes. Okay, what else I want to show you? Before I move away from the indexes, the old VIX volatility index still coming off the divergent low right here. We have that positive divergence, pretty big positive divergence right there. And we had a breakout of this most recent downtrend line, breakout back test, and we're still above it. So that's that. So the breakout's still intact. Last one didn't go too far, went up. Well, actually, no, I'm sorry. It went very far. Broke out, came back in, had a nice rally. And, where this goes, it depends on where the stock market goes. I just showed you the bearish case, break those downside levels. VIX will probably explode. Minimum target. If we're going to hit, as I said, if we're going to hit my 20 to 30, I'm closer, leaning towards that 30% downside in QQQ. We're going to see the VIX take this trend line out. We're going to see it probably take out that $37, $38 level. So that's the potential upside I see in the VIX. That's well over 100%. And hey, if we break to the upside, VIX probably going to go back down. May fall back down to this next support level we're at. Support, we just hit it. We'd probably come back down here to the 1150 older support level range or zone right there. Okay, other trade ideas in no particular order. I should have started out with wheat. I just booked profits on wheat today, and it's more of a function. We're still under my second target. More of a function. I'm just getting my ducks in a row to leave town. We came very close to T2. Close enough. Sold all. I guess we pulled back a little bit. I probably should have started with this one, but noted this Friday. Figured we'd carry up, maybe hit T2 before, but we got close enough today. And again, that's just me. We may zigzag up, and we may still hit T3. But again, I'm just kind of lightening things up before I leave town, and wanted to mention that negative divergence could play out for a little bit deeper pullback. That's still T1 at 649, 650 was resistance, and now should become support, and that would be one objective level. And you still have R1 about 626 there. That would be, if we get a pullback, if this divergence plays out to that level, that may be a nice re-entry point for a swing up to the next targets. And we came close enough to T2 now. It was effectively hit, so we probably power on through it if we do get something like that. So if you're still in it, just raise your, just set stops to protect profits. What else do I want to cover for you? Let me cover some of the trade ideas that I threw out recently. Many of these I'm still in, I've recycled in and out. We've hit targets on some of these, but I'm going to go through all these in the last few months. So MBI, I forget exactly where we shorted it initially, but we hit the first and second target. That target was hit right there. I didn't mark that. T2 hit, and we'll just leave it white for now. Bounced, went down, hit our first target, second target here, bounce. And the PPO remains in bearish territory below that zero line right there. That tends to delineate bull and bear trends, and we're solidly below it now. Rallied back up, just back tested that trend line. But I'm still, at this point in time, still maintaining T3, and that's down here about $6. What else I had? AMBC, that's a bond insurer there. AMBC is another one, hit T1. We just hit T1 again. Remember, it came off this divergent high, big bearish rising wedge break, back had a little kickback rally, and I guess in the last update I would have highlighted this. It was support here, and then it became resistance. So we hit T1, we bounced, as is usually the case. That's why I have multiple targets. Ran into resistance, fell back down, hit T1 again, and sooner than later I expect that to break. PPO is still in bearish territory, and I maintain these other targets from the initial trade. Or I guess I updated, I added targets on it. Anywho, that's AMBC. Still looks good as a swing or trend short. You're just in a sideways market. Look, this is not mere coincidence. The market's going sideways, so a lot of stocks are. It's either going to pan out or not. And if it pans out, it's probably going to, almost certainly going to be because the market goes down, or most likely. And if it doesn't pan out, and this is why you can stop out now. We've already had several reactions there and got rejected. This is where a stop should be, right above that resistance there. And that's it. Let it go, or let it run down and hit those next targets. Caterpillar, same thing. That one hit T1, first target there, bounce, hit T2, little reaction around T2, and down, hit T3, bounce, put in a divergent low here. But you can see this is the case in a bear market. Positive divergence, all it played out for so far was just a minor little bounce. Right now, I'm going to add a trend line here. You've got a pretty decent trend line, and although you had that divergence, you still have even bigger divergence now. So, look, if the market's breaking to the upside, CAT's probably going to break it as well. I still maintain T4. We haven't hit, and T5. If the market has a false breakout, then what you might see is a false breakout here, and then a move down. And remember, in a bear market, if that's indeed what we're still in, divergences often fail to play out for anything more than usually just a brief rally. And this is still resistance. This is where T2, I think, an objective stop. If you're swinging this one down to T4 or 5, somewhere a little north of that, 226.30, maybe on a closing basis, makes sense in my opinion. Just looking at my scratch pad from a couple weeks back, so I'm going through in no particular order. T-Zoo was a long I gave you here. I think we took it over, break over 570, hit our second target. Oh yeah, I did an update on this recently. Ran into that 815, and then I recommended if we're still in it, to reverse, take profits and or short it. So we've had a nice pullback from that, run into the 815 level. It's down about 10%. Let's see, TIPT, Tiptree just hit T2 yesterday, or Friday, I'm sorry. I didn't post an update out on the site, but there it is. Came in, broke out here, back to that trend line, and I still maintain T3. At this point in time, T1 was a very, very good, well-defined support level. So that's where an objective stop would be to protect profits. If you entered it on the breakdown, everyone's different. So that's where I think an objective stop would be. And if you're not in it, or you took profits at T2 and you want to recycle, if you get a pushback to anywhere a little below that 1383, that would be an objective short entry, with again a stop somewhat above. I would say somewhat. You've got to account for stop raids. It's almost a sure thing in this market, and in recent years with the algos and the big, they know where the stops are placed, so they try to run it up. So that's why I always say stops somewhat above resistance, and if you can allow it on a daily closing basis, that'll help prevent those intraday stop raids that clear the stops, and then then they cycle in short and swing for the next leg down. So there's TIPT, still maintaining T3. Natural gas, let's talk about that one. Recently we've been putting in these divergent lows. You had a breakout and a back test here, rallied. You had a breakout here. That was, I think, the last update. That breakout didn't really get any traction. But we came back down to make a slightly lower low, and this is actually bullish. You might say, no, Randy, that's a break of the previous lows. Well, when you broke it, technically yes, but then you recovered pretty impulsively, so that makes that a false breakdown. A lot of traders will call it a bear trap. Short sellers will step in and short the break of the previous low, and all along you've had divergence growing bigger and bigger and bigger. In fact, that divergence, as I showed you before, you can see out through on the daily chart. This is UNG for you ETF, ETN traders. You have big positive divergence forming here, and it looks like we're getting pretty cheap in natural gas. And remember, natural gas is a commodity. Commodities do not declare Chapter 11 bankruptcy. They don't they don't have the issues that publicly traded companies do. They're going to be around. They're not going to go to zero. In other words, there is no set floor for natural gas, but we know we're at the lower end of the range, and we also know we're in the most hyperinflationary environment in nearly half of a century. So therefore, unless that ends, you can buy commodities on pullbacks, and especially when they're divergences are at support. And if nothing else, it's a way to diversify. On commodities, gold considered a commodity, also considered precious metal and industrial metal. It's got a lot of applications, but kind of hanging in there. A lot of people want to buy gold with the fear in the regional banks and everything lately. We put in that doji stick, but we made a marginal new high, but still a divergent high. So my outlook on gold hasn't changed. That's big support. There is there are cross currents. The technicals, you have these divergences forming. We had them here, and yes, you had a little correction, made a marginal new high. But at the end of the day, I'm more bearish than I am neutral right now. I was going to say I'm neutral. I was for a while longer term bullish, looking for new highs in gold, and still think ultimately we'll get them. Just at this point in time, there's the divergences, the price action. Everybody's kind of been a one-sided trade lately, and I think that's what's keeping gold from going up. It's kind of stalling out here recently. And remember, GDX also hit that T4 level right there, which is resistance, big resistance. Put in a divergent high as well. So you've got the divergence on the metals, and like I said, the risk reward right now is not favorable. It's, in my opinion, more favorable for being short. Just like the stock market, I see at this point in time minimal upside in the metals, just like I see minimal upside in the stock market. There it goes. My line's finally loaded. There's our most recent divergent high in silver right there. And then I'm going to wrap up two more. We'll do the banks and the financials. SOX, really, it's playing out. It's just a slow roll. Divergent high. Get T1 back here. Or T1's right there. T2 zone we hit right there. Said we'd probably get a little bounce or some things there, and it got a little bounce, but we're zigzagging lower. You take away all the lines. Again, bears can't declare victory. I mean, if you took profits at T2, you can declare victory, but I still have and maintain the additional downside targets here all the way down to T6. So that would, if hit, that's going to be about another 20% drop. And I may extend that as well. You look at the weekly charts and you look at my targets on QQQ. I doubt we're going to see QQQ fall 30% and see the semis only fall 20%. That's going to be about 34% to that T2 level right here. Had it as the trend line or 271. At this point, I think we'd probably come in. My guess is if we get going, as I talked about, the selling accelerating as we start to get down near those old lows, and I think we'd probably overshoot that briefly, hit that, and then close back on that trend line by the end of the week would be my guess. Okay, and let's just wrap up with the financials. KRE, it's all been about the regional banks lately. And remember, we put in some big divergences the other day. If the bear market's over, let me be simple. If the bear market's over and ended in October of last year, and we're going to new highs, this is probably the best sector right now, in my opinion. You've got big positive divergences on a lot of these bank stocks, as I mentioned on Friday. And if those divergences play out, that's going to carry KRE probably at least a back test the bottom of that. That was a big support level right there. And that in itself would give us about 50% upside. Some of the big ones like Pac West already popped quite a bit. But I'm looking at, here's what I'm looking at. You know me, I'm always looking where are the issues. Let me just sort my list real quick. There's still a lot of these regional banks that are not, they're not looking good. Their prices are way down. Fundamentally, you've got the commercial real estate. issue. Read up on that if you're not familiar with huge vacancies. And these guys own a lot of that paper. And also the auto industry. I may give you a link to watch a video. There's a couple more that guy's put out. I believe that's another shoe to drop. And these banks are going to feel the pain. But anyways, you can go through there, and like I said, just sort the watch the components, and you'll see where there's trouble. And it's not just the regional banks. You look at things like the broker dealers. Keep an eye on Schwab's been on everyone's radar lately. Schwab is just it's not rallying. You have the divergences, so it's kind of do or die time for the bulls. And the insurance sector, I've already given you that. I gave you this trade idea before we hit that target last week. Insurance, you're gonna look at life insurance, property casualty. Let's look at property casualty, and then I'll wrap this video up. That's not the one I wanted. Insurance. I need to go to the IX. That gives me the components. IX. There it is. IX 1250. And we'll rifle through some of these that just aren't looking so good. Hallmark Financial Services. This is a stock this is not looking good. This stock should be rallying. The regional banks are rallying. Again, I think all eyes are on the regional banks. That's what they're talking about. And I'm always looking at where's the next potential shoe to drop. Call me a glass half empty guy, but in a bear market, like I said, and others have predicted these cracks in the financial system for quite a while. They're materializing, and to me, looks like it's just getting going. Not that it's over. Every time we see a little, Fed step in and backstop the regional banks, or a bear market rally, and there seems to be a mentality it's over. And hey, maybe it is, but we'll only know that in hindsight. What I am seeing in real time, more and more cracks forming. Again, it was crypto, then regional, then the big banks, Credit Suisse and some others, and I'm looking at insurance companies. I'm looking at brokers that the stock market is saying there's something going on there that may not be being talked about. So, anywho, watch those, and for potential cracks. And there's some that, hey, the bear market is over. Look for these, with divergences. Ideally, you want to look for things. Don't chase penny stocks. Look for stocks that are at support, and then look at the overall sector, because birds of a feather flock together. So before you start gobbling up longs in any one sector, you want to make sure the sector looks pretty bullish, or you can make a case to buy the sector itself, and then dig down and find the most bullish stocks. Likewise, if you're bearish, you can find a bearish sector. Same thing. Look for the most bearish setups on the individual stocks, and that's the way to trade it. Okay, long video, but I think we'll wrap it up here. That's not all what I'm watching. I'm flipping through my notepad here, and I think that's the gist of what I wanted to cover today. So again, if anything new develops, I'll get it out to you. And like I said, the one thing I'll leave you with is that this market will sooner or later break one way or the other, and I don't know with this debt ceiling how much longer we can grind around sideways, but just be ready. That's one thing I say. When complacency, everyone starts to get into that, the market's not going to do anything, and they kind of give up. That's usually when the big move comes. So be ready for it. It can go either way. Which way I think it's going to go. But again, very important, at least for me, I'm not getting married to any one bias. You get married to a bias in a bear market or a bull market, it will crush you. So I'm going to wrap up here. This has been Randy Finney with Right Side of the Chart. Have a great day.